Stay tuned for Butler on Business, coming up next on the Liberty Express.
Okay, welcome back to Butler on Business. On the phone with us now is Ellen Brown. Now, I know her as a prolific writer, but Jason, why don't you tell them a little bit about Ellen?
Ellen, yeah, she is a writer. She's also an attorney and president of the Public Banking Institute. Her latest novel, latest of 11 books, actually, Web of Debt, she shows how the power to create money has been usurped from the people and how we can get it back.
Ellen, thanks for joining us today.
Thank you.
And, you've written a whole lot lately, so I don't know where to begin. How about big bank bailouts stifled local lending? I think a lot of people remember old Paulson and Bernanke standing up there telling them, give us the TARP so we can keep lending the money. And then all my business buddies, what they saw was quite the contrary. Their credit lines either slashed or eliminated. They're not lending money to businesses.
That's right. The bailout totally worked for the big banks. It did save Wall Street, and admittedly, it would have been a disaster to have some of those big banks collapse. But it worked at the expense of the local economy. It didn't help the local economy. What they did was lower the Fed funds rate very close to zero, so the cost of funds became very cheap for the big banks. So they really have no interest in making local loans anymore. They've cut back drastically on their local lending by 50% for the top 5 banks, which have like half the market is, or half the deposit base is in those big banks, and they're not returning it to the local economy. They're using those perks that they got from the bailout for much more lucrative things, speculating, or what they can do is just buy up long-term government bonds that we, the taxpayers, are paying 2.5% or 3.5% interest on. They can buy them up at that borrow the money at that very cheap Fed funds rate, and then turn around and buy very secure bonds that don't even have a capital requirement, so they can buy lots of it. So meanwhile, it's the local banks that make loans to local business. It always has been. But the local banks are having trouble. The reason they've cut their credit lines is that they can't get the liquidity anymore. They can't get funds from the other banks. There's $1.6 trillion in excess reserves in the banking system, in the Federal Reserve, in reserve accounts. But it's the big banks that got the reserves from the quantitative easing, because it was the big banks that held the securities that the Fed bought, if you know how quantitative easing works. Anyway, it's not like these reserves are equally distributed across all the banks. The big banks have them, and theoretically the little banks could then borrow them at the Fed funds rate, except for the fact that the Federal Reserve took the additional step of paying interest of 0.25% on the reserves. So the big banks have no reason to lend that money to smaller banks at 0.25% when they can get the very same thing from the Fed and hang on to the reserves, and they have them for themselves if they need them.
You know, a lot of listeners, we have pointed this out, but I think it's hard for people to grasp that the Fed is in essence paying these large banks, their bankster buddies of theirs, not to lend the money.
Yeah, it's unbelievable. Well, I understand the theory of it. If they didn't pay that interest, then they would totally lose control of the Fed funds rate, because it would go below 0.25. Well, that's the theory, because there's all this excess reserves out there, so nobody's going to want to borrow them at all, so nobody will pay any interest on them. But that's not what's happened. Although there are these huge excess reserves, they're totally concentrated in certain banks, and so the other banks are just squeezed out and can't borrow at all. So it's a misguided model, and the reason they're paying the interest, the other reason is they want to hold on to those excess reserves, or they're worried about sterilizing it. Like, they're afraid if they let those excess reserves out, that the money multiplier effect would turn that into many more times that sum in loans. But again, that's not how the money multiplier works. The banks aren't lending not because they can't The big banks aren't lending not because they can't get reserves. They already had all that. For them, the problem is the capital requirement and the fact that they have more lucrative things they can do with it now, less risky things. So this whole fear of hyperinflating the system is misguided. We have a contraction in the credit system, and they need to let that money out there.
Ellen, now back on July the 11th in Seeking Alpha, you wrote an article, Why QE2 Failed, the Money Went Offshore. Could you share that with our listeners?
Well, that was another oddity that the Federal Reserve in quantitative easing 2, their second quantitative easing program, it just created $600 billion on their books, as the central bank is allowed to do with computer entries, and bought $600 billion in long-term federal securities. Well, it used to be they could just walk over to the Treasury and buy the bonds up until 1935. That's the way it was, and that's the way it is in some other countries, and it works quite well. So basically, the Federal Reserve would be monetizing the government's debt, but because legislators were afraid that would make it too easy to spend, for Congress to spend, they put in this requirement that the Federal Reserve could only buy on the open market. So the only way they can buy these long-term securities that they want to get of the federal government is to go on the open market. Well, there are 20 banks, dealers that they can buy from, and it turns out that 12 of them are foreign banks. And the foreign banks, and it's all done at auction. So of course the Fed doesn't choose which banks win the auction. Well, the foreign banks had more incentive to bid to sell their bonds or to get the cash, because first of all, they have a nice carry trade going on. These are foreign banks with branches in the U.S. So they have this nice carry, like Deutsche Bank, that sort of thing. So they have this carry trade going on. It's very profitable for them to have the cash, and they have a liquidity crisis of their own going on in Europe with the euro. So they got the money. So it's sitting in their accounts, their reserve accounts. So it didn't even go into U.S. bank reserve accounts. So,
Ellen, now one of the things you've written about is how we can gain control over the creation of money, which was usurped by the Federal Reserve back in 1913. Could you elaborate on that?
The Federal Reserve is, most people think, of course, that it's a federal agency, and it is sort of public-private at the top where the Federal Reserve Board is appointed. But all 12 branches of the Federal Reserve are privately owned. They're 100% owned by the banks in their district. So, for example, the New York Fed, which is the largest branch, is owned by about 500 banks, the New York member banks. So they managed in 1913, when there was a particularly bad bank panic, they persuaded Congress to pass this legislation, which would allow the Federal Reserve to print the national currency. This would be their Federal Reserve notes. Before that, banks did print their own banknotes, but they were supposedly gold-backed notes. So theoretically, you could take your paper banknote into the bank and get gold. So it was really just a receipt for gold that had been left in the bank or that had been borrowed from the bank. But because there was way more notes printed than there was gold, they would periodically have bank runs when people would figure that out, and they'd all rush to the bank at once and try to get their gold. So the banks weren't lending to each other because they didn't trust each other to have the gold. They knew they didn't have the gold, so they figured the others didn't either. So there was this sort of freeze and panic, and then the Federal Reserve stepped in, passed by Congress. One thing they did was to impose to do
reserve
check
discipline.
Clearing. Yeah,
right?
Reserve requirements and check clearing. So everything had to pass through the Federal Reserve. So when you cleared your checks, instead of just doing it privately with another bank, it had to go through your reserve account at the Federal Reserve, so they knew you really had the money. But really, all you had still was your depositors' money, so they're still creating money because they're double counting it. They're lending out the same money that they just told the depositors that they could come for at any time. So the Federal Reserve is actually, according to their the language in the Act, they're there to serve the banks. They can only lend to banks. It was suggested that perhaps, since the state and local governments are suffering because of this Wall Street bailout, I mean, it was Wall Street's fault that the credit dried up, that perhaps the Federal Reserve could extend these same very low interest loans to state and local governments that they had extended to the Wall Street banks. That was last January, and Ben Bernanke said, no, we're not going to do that. Obviously, it's not because they couldn't afford it, because they came up with $12 trillion for the banks, so they could have come up with $161 billion, which is all it would have taken to pay the state, or to balance all the budgets of all the states. It would only have taken $161 billion. But he said we're not going to do it because it's not in our mandate. In other words, it's just not written into the Federal Reserve Act. So he said if Congress wants us to do that, they're going to have to change the law. So the Federal Reserve is set up to serve the banks. It's not set up to serve us. And that's what we need is a banking system that would serve the people. We need to take the power to issue our own currency back from this private banking system, and we need the power to issue the national credit for the benefit of the nation and not for a private banking monopoly.
All right. Well, listen, thank you very much, but we are on a break.
Okay, thank you.
Good talking to you. This is Alan Butler, Butler on Business, and we'll be back in a couple minutes.